Okay. Hi, everyone. Welcome to the Timing Research Show for March 23rd, 2015. My name is David Kosmeter. I'm the creator of Timing Research. And today we will be discussing the 78th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download it there. I have Dave Landry guest hosting for me again, so I'm going to go ahead and turn it over to him.
Okay, thank you very much, David Cosbit, for having me back once again this week. Also, thanks to Timing Research for having me host the show. Can you guys hear me okay? It looks like there was an internet glitch here right as we were getting started. You guys see and hear me? Or?
I can.
Okay.
All good.
Yeah.
Yeah, fine.
You might not want to see me. I have a face for radio, but anyway, looks like we've got a pretty good lineup today. These are all friends of mine. Neil Batho of TraderReview.net. He's a friend of the show, and that's how I got to know Neil, and I'm living vicariously through him as he travels the world and trades. It sounds like a lot of fun. Corey Rosenbloom, I've known him forever. And Corey and I go way back. He was one of the first guys that I met starting out in this industry. And Eddie Z I met a little bit more recently, and Eddie Z wrote a book, interviewed some traders, and he was kind enough to include me in that. So let's start off with you, Corey. Corey Rosenbloom of AfraidToTrade.com. Corey, for those of us who don't know you, tell us a little bit about your trading and tell us a little bit about trading. I'm sorry, AfraidToTrade.com. I should know that.
Sure. Thanks.
To you, Corey.
Thanks for getting me back on. Greetings, everybody. I started Afraid to Trade in 2007 when I went full-time and in the day trading sort of arena. But I came to the markets in 1999, and the bull market was in really much full swing there as a fundamental analyst, and so I married the fundamental and technical world. And so right now I'm mostly in technical analysis, but the Afraid to Trade blog discusses daily commentary, adds a little touch of psychology, overcoming fear, particularly emotions, or a lot of what we deal with as traders. It's knowing what to do, but also doing it. So Afraid to Trade helps with that. Of course, that's membership commentary, research, and any kind of things I'm looking at in the market, scans, and all sort of things for traders.
All right, Corey, good stuff. Good stuff. Next up, we got Eddie Z of EasyTradingComputers.net and EasyBreakouts.com. Eddie, tell us a little bit about yourself, your trading, and a little bit about EasyTradingComputers.net and EasyBreakouts.com. Did we lose me or Eddie?
I think I'm here. Can you hear me?
Yeah, we can hear you, Eddie. Go ahead.
All right, thank you. And yes, it was great interviewing for the book. Eddie Z's interviews with Wall Street's legends, gurus, all-stars, and Hall of Famers. And you are all of those things.
Oh, thank you so much.
Thanks for having me on the show. First off, I'll talk about Easy Breakouts. And Easy Breakouts is a website where I teach people how to day and swing trade stocks, specifically how to trade breakouts. We look for stocks that have a really high probability of a breakout either the next day or very, very shortly. And I teach people how to isolate where that breakout point is and what are the characteristics of a breakout. And then once they enter the trade, how to manage the trade. And there's some psychology in there as well as a methodology for managing the trade. So that's Easy Breakouts. And then Easy Trading Computers is I'm probably now have become the leading provider of computers to traders, I believe, in the world. I think I've passed up my competitors by now. You're welcome to check out that site, EasyTradingComputers.net. Get the buyer's guide. I explain to traders exactly what they need to have the ultimate computer setup for trading. Whether you use one monitor or multiple monitors, I will show you exactly what you need to get an awesome setup.
Cool. Okay, next up we got Neil Batho of TraderReview.net, and I think you also have TraderReview.com at this point in time. Neil, you just said you're in Nepal, or you just left Nepal?
Yeah, I was in Nepal for about 7 weeks.
Wow.
Hanging out in a village near the Himalayas, so it's a really beautiful place and good internet. So I figured why not? And to be honest, a really good time zone for trading.
That was
'Cause you do
that was
whatever
my
you want
next
during the day and
question.
trade at night.
That was my next question. What kind of reception do you get up there in the mountains? That's pretty cool. That's really awesome. I think, as I said earlier, I live vicariously through you. So Neil, tell us a little bit about your trading style, and tell us a little bit about TraderReview.net, or would you prefer to be known as TraderReview.com?
Yeah, we'll go with the .com. I just have both, and it's a long
Okay,
story, but it all started with the .com. And
gotcha.
sure, my trading style is basically my favorite picks to trade are the strong trending trades, but really you have to trade what the market gives you too. So if there's something that's been going down for a long time like oil and it's breaking out off the bottom, we traded that as well. And if there's breakdowns in the market, we'll short them, and I'll use leveraged inverse ETFs as well. So you basically trade what's available in front of you. You
Amen.
can't necessarily say, this is my trading style and that's just what I do. Let's have it market, And I also time the market too, using some indicators like percent of stocks above their averages and bullish percent, which has been extremely effective over the years since I've done this, and actually learned it when I was a broker back in 1999 with some guys. I did a webinar, or not a webinar like we do now, but a real seminar where we sent out a mailing and got people to come in, and using point and figure technical analysis, which is one of my specialties, and that's where I learned it way back 1999. Then started Trader Review.
Cool. My name's Dave Landry. For those of you who don't know me, my website is davelandry.com. I am slotted as a swing trader, but I will stay with positions as long as they move in my favor. Someone asked me what my ideal holding period is. I'll say 10 years or 20 or 30 years at least. But the reality is the money management takes me out much quicker. But sometimes we can have these swing trades actually turn into trades that last for months and even years, and we're taking partial profits along the way, and we're widening up our stop to stick with those positions. And the reason I trade it this way, it's kind of a hybrid approach, and the reason is because you can only predict the short term when it comes to markets, and that's how I got started as a swing trade. But I learned very quickly that the real money is in the longer term trend. So by marrying these two approaches together, simply by taking partial profits along the way and trailing a stop and letting that stop widen out a little bit as the position moves more and more in your favor, you can position yourself to capture these longer term moves. I have a 21-page report on this. If you go to davelandry.com and click on the store button, it's the first one in the store, the free reports, or you can just go to davelandry.com/store. One thing I want to mention to those of you who are watching this on YouTube, if you're watching it on either my channel or Dave Cosmitter's channel, which is Timing Research, make sure you like us down here, and also subscribe to those channels, and you'll be able to get these videos and other videos from us as soon as they're made available. Okay, let's kick off the questions here. Corey, you're first up. Based on the technical or fundamental indicators you want to use, would you predict that the S&P index will move higher or lower by the close of this week, and that's Friday, March 27th? And then after you give us your ranking analysis on that, higher or lower, could you give us your confidence on this, rate your confidence to your answer on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confident? You would think it's the first time I've ever read this question. All right, Corey, over to you.
Oh, goodness. Well, as a professional trader, seeing the report, and the membership came in at, I think it was 79% higher in terms of sentiment, and as a trader, I'm salivating to go short off of that in terms of sentiment. We want to fade the sentiment, but my goodness, this bull market continues, and we're just basically near new highs. So if I had to make a suggestion or make an absolute prediction, bullish, confidence level going up 6, 7. But as a trader, I'm going to focus my attention on this 2120 level in the S&P. Just the thesis, if we break above that level, I would expect the short squeeze to continue, short sellers, bears take their stop losses, bulls get in, and more enthusiasm, excitement takes this market higher if we get that trigger above the new high. So 2120 S&P is about 5,030 in the NASDAQ, and Dow Jones about 18,300. So that's your key levels to watch at that point. Otherwise, the breadth is strong. We're seeing all these things take place this week. We have GDP on Friday, so market could rise up and then fall sharply on GDP, or just the opposite. But we'll be watching some economic reports, new home sales, CPI, etc. But my focus this week is going to be on that new high level. If we're above it, I'm just bullish, bullish, bullish. If we're beneath it,
Okay.
I'm a bit cautious. But yeah, I'm going to be bullish with about a 7 confidence level.
Okay, and yeah, save some of that for the question number, whatever question is coming up. But yeah, good stuff. Okay, Eddie Z, based on any technical or fundamental indicators you want to use, would you predict that the S&P index will move higher or lower this week? And that's Friday's close of the 27th. And once you answer that, rate your confidence in your answer to question number 2 on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confident.
I'm going to say higher, and I'm going to be at least a 7 to a 7.5. Can I break it down to a 0.5?
Yeah, what the heck.
7.5.
Just for you, Eddie.
Thanks. Do you want me to give my reasons why?
Yeah, let us know, and then we're going to elaborate on that in the next question too. But give us a few short reasons why, and then we'll get to.
Nowhere else to put money.
Amen, brother.
That's the easiest reason. There's nothing else to put. There's nowhere else to put your money. Negative rates of return in Europe. I can keep going on that.
Yeah, no, I mean, and that's a scary reason too. That's come about a month or two ago. That came up in a lot of detail in this show, and I'm thinking that, boy, that's a pretty scary reason, being the only reason for a market to go up. But so far, so good. As a trend follower, I'm not going to fight it. Okay, Eddie, we'll come back to you on that one too. And your confidence is 7.5. Okay.
Yes.
All right, Neil, you know the routine. Based on any technical fundamental indicators you want to use, would you predict that the S&P index will move higher or lower by the close of this week, and that's Friday the 27th? And then once you give us that, give us your confidence on 0 to 10, with 0 being no confidence and 10 being extremely confident.
Who was this for? Was this for me?
Yeah, I'm sorry, Neil. Did I say Neil?
Okay. Yeah, I'm going to go with bullish as well, but
Okay.
it's true. We also have to look for the breakout at about Dow 18,3000, because right now, a lot of people, you don't want to be getting in right before you think there's going to be a breakout. That's kind of a recipe for disaster as a consistent strategy to use. But you can there's still some room to go to that 18.3 level. So I'm going to go with bullish, go with about a 7 or an 8. And all the indicators that I use have ticked up, so I think things can still keep going. I don't see any reason for anything to change. One of the things I would look at, well, no, forget it. I'm just going to go with that right now. Still bullish.
Okay, let's nail you down on your confidence. Let's 7.5, split the middle.
Sure.
You're getting a little too relaxed over there. We got to bring you back to the States with this hustle and bustle.
No. I make my best picks over here. We have 10 winners in a row.
No, you're focused. Yeah, you're getting centered over there, huh? All that Eastern getting centered and all. That's good.
I meditate 8 hours a day.
I'm going to stick
Dave,
with the upside too. That's a great idea. I'm going to stick with. I'm going to agree with everyone and stay bullish, which I guess is kind of scary that we're all bullish. I think we're a little overbought. We were oversold last week, and that's one of the reasons I was bullish, because I thought we'd get a bounce from oversell. So the main reason is this market in general has gone up for many years, and I don't have any sell signals at this point. When I say that you can only predict the short term when it comes to markets, one or two of my clients thought I meant that I could always predict the short term, and that's simply not true. But there are times when the market is set up, and it's a little bit easier to predict than others. Right now is not one of those times. But I'm going to err on the side of the longer-term trend. The S&P 500 is, I'm just kind of eyeballing it, but I'm guessing about 1/3% away from all-time highs. And one thing that I often preach in my column is that as long as the market is at or near all-time highs, don't fight it. And the other thing I've been saying quite a bit lately is I think it's going to be really hard to have a bear market as long as a broad-based index like the Russell 2000 remains at all-time high. So I'm going to stay bullish, and I'm going to just agree with everybody else. I'm going to go ahead and give it a 7.5 on that. And one of the big complaints about the show is not enough not enough controversy. So I guess maybe next week we'll have that. We'll get somebody on that's controversial. Or maybe Neil and I will pick a fight later. How's that? All right, Corey, let's go back to you. What developing events, and they could be technical or fundamental, will you be watching out for this week that might have a positive or a negative impact on the S&P 500 and other U.S. markets?
Yeah, I jumped the gun on that one. It's
okay.
the GDP report. Friday's, that's going to be my focal point for the week. A lot of that economic indicators are built into that, so we know that. But if it's a big surprise, say under 2%, it's difficult to tell in the sense that in typical environments, a lower GDP is a bad thing for the market. But in this environment, that means the Fed would probably push back their interest rate hike scheduled for later 2015. So bad news could be bullish and push the market straight up to new highs. So I think my focal point for this week is going to be that. Otherwise, yeah, it's a technical level. The new high, just on the thesis, if a breakout occurs, it's going to trap a lot of traders and push them to the side, to the exits in that sense, and push the market higher. Otherwise, not a whole lot of thing on the economic sort of scale. Looking at the chart, looking at fundamentals, not so much, but breakout levels would all focus my entire attention on this week.
Okay, cool. All right, Eddie Z, you're next up. What developing events, and they can be technical or fundamental, will you be watching out for this week that might have a positive or a negative impact on the S&P 500 and other U.S. markets?
What am I looking out? Well, just really the overall action of the stocks. I mean, I think we can see the NASDAQ has made new highs. The S&P is pretty close. And what you're seeing, you mentioned the Russell, and you mentioned, well, you didn't mention, but I'm mentioning like the mid-cap index also making new highs. And so you're seeing some money start to come out of the multinational stocks a little bit and go into the mid and smaller cap stocks. It's not leaving the market. It's looking for profits that come from the United States as opposed to some of these multinationals that might have some exposure to Europe. And so when I think back to some of the massive bull markets we've had, including especially the 90s, the money came out of the big caps in like, it never really came out of the big caps, but the big caps slowed down in like 97, and a lot of that money started to roll into the mid caps and the smaller caps. So even though this has been a market that's been moving up for an extended period of time, it's, you know, sometimes you look at it and you say, wow, tremendous run we've had from the lows. You can't fight it. Money's not necessarily coming out of the market. The other point, I mean, which really isn't something I'll be looking for this week, but just the fact that, I mean, in having inflation, we have no signs of inflation. When you factor in the oil situation, it almost becomes impossible to have inflation. I mean, the Fed is really stuck because if they raise rates, they create even more money coming out of overseas and coming into the United States. They create an even bigger problem. Plus, there's really no inflation. Would we all like to see a return to normalization? I think it's inevitable. We have to get back there, normalization of interest rates, but they're really stuck. They're a little more stuck than they let on to raising rates, and that's why. And there's just no other place to put money.
Yeah, how do you get back to there? I mean, they painted themselves in the corner, free money forever, and now that everybody's so used to it, I don't know. And I think that it seems like Europe is, as somebody said earlier in this show a couple of months back, Europe is taking a book out of our page, and they're going to use a bazooka too to try to get things up and going.
Yeah,
well,
they have some other issues for sure. I mean, between the political uncertainty there and. I mean, they're like all borderline communist countries. There's something controversial for you.
There you go. All right. Finally. Okay, Neil's over there, nice and centered. He's going to give us a nice, clear answer on all this. So, okay, Neil, what developing events that can be technical or fundamental will you be watching out for next week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, one of the things that I wanted to point out that the Fed is using, or say that they use in their rationale for raising and lowering rates, is the Phillips curve. If anyone's familiar with that or likes to do research, and the Phillips curve is actually a complete and total utter lie. And what the Phillips curve does is it says when unemployment is very low, so you have full employment, that it will therefore cause inflation, so the Fed must raise rates. And that was the excuse they used in 99 and 2000 to basically crash the entire market. But the thing is, the higher employment you have, so very low unemployment, increases competitiveness, therefore lowers prices while increasing quality, and does not cause inflation. So this is a big scam they have going there on their rate analysis. But the big thing that I'm looking for is the U.S. dollar, because as the U.S. dollar goes down, gives you a huge opportunity to trade some bear rallies in all commodity stocks. So that's a really big one that I'm looking for.
Gotcha.
And when it used to be for almost 10 years, since 2003, that whenever the dollar went down, the market went up, because the market became increasingly more commodity stock based. So if you were to take the overall market cap of the entire market, more and more of that slice was commodities, and more of it was dependent on the dollar going down for basically the market to go up. But now that's completely decoupled, and it doesn't seem to matter anymore, because now you have the dollar down, market up. It used to be dollar down. Okay. Now even if the dollar's up, the market has been going up for basically about a year now. Now the dollar's down a few days, doesn't matter. Market's still up.
Yeah.
So
yeah.
I'm really looking at that.
Absolutely. As I mentioned on some of the shows previously, I would suggest everybody read John Murphy's book on intermarket technical analysis. I have it on my website if you dig around enough for books that you should read. But anyway, I think it's a good book to read. But then once you read it, and even Murphy says in the book, there are long lead and lag times. So they couple and they decouple. So it only matters when it matters. So learn all these relationships, but then don't worry about them or don't be too concerned with them unless they're coupled or happen to be coupled or decoupled at the time. Okay. Did I cut you off, Neil? I just kind of was agreeing with you, I guess.
Yeah, thanks. No problem.
All right, cool. Okay, I'm a technical trader, 100% technical trader. I get a little news through osmosis, and it's usually on Mondays while I'm doing this show here. So it's kind of I kind of enjoy coming on to get a little news, and then I completely try to put it out of my head as quickly as possible. Just a couple of things that I'm thinking about here. Don't fight it. Since 2009, this market has just pretty much gone up. I've had a couple of sell signals in between, and a couple of them had paved off okay, and we take those signals as they occur. I think everyone's a little bit too complacent with this market, and they think that it's just going to go up forever. Eventually, it's going to hit badly, but I'm not going to worry about that as a trend follower. And then my nickname, actually, in the industry, to those of you who don't know me that well, is trend following moron, because I just sort of follow along with the markets. I've given up trying to fight it and figure it all out years ago, and now just follow along, and my life has gotten a lot easier ever since. I think as long as we're at or near new highs, I'm not going to get too excited about the market. 2100 is where we are now in the S&Ps. We're not too far away from all-time highs, so as long as we can hang around there, especially in the Russell 2000, which I'd like to watch, and of course the NASDAQ too, because it's fairly broad-based. Or it's very broad-based, I should say. So as long as we're around those new highs, I'm not too worried. Where else are you going to put your money argument? Just came up a little while ago. That's the scariest argument I've ever heard for being in the market. But so far, that's worked for quite a while here. So it's kind of the church of what's happening. Church of what's happening now. As long as that continues to work, I wouldn't fight it. The way you don't fight it is you watch for new highs, and as long as we're making new highs, then let's not get too excited about the overall market. When we do get a sell signal such as a bow tie, and if you're watching this video on my YouTube channel, if you look listed on my channel, I have a video just on bow ties, and that's when you have a 30-day exponential, 20-day exponential, and a 10-day simple moving average cross over a short period of time. And these signals could be especially powerful if a market is coming off of all-time highs. So I would certainly be watching out for that, and until that occurred, I wouldn't get too excited about the market unless we have a sharp drop. The only other thing I want to mention is that I'm fortunate, I'm sure you guys are too, because you're out here in the public talking about markets and you interact with a lot of clients. And one advantage that I think that's one huge advantage that we have over somebody who's not doing something similar. And I get a lot of emails as soon as this market has a downtick. I get a lot of emails telling me how this is the end of the world, and I suppose you need to predict early and often. But I've been getting these for quite a while, probably years, and it seems like everybody is betting on this market to fail. And I think eventually they're going to be right. It's kind of like in 1999, in early 2000. We all knew it was going to eventually end badly, but it went a lot further and lasted a lot longer than most people were willing to believe. And that's why I think you just need to follow along as a trend follower. So will it end badly at some point? Yes. Am I interviewing myself? I suppose. So that's my take on the market at this point. But again, as long as we're hanging around new highs, let's not get too excited. Okay, let's go to the open-ended question of the week. Let's go over to you, Corey. And the question is, do you trade or invest in gold in some form? Do you think gold is an important investment in your portfolio? Wait, hang on one second. I left out a word. Do you think gold is an important long-term investment in your portfolio? All right, Corey, you're up. You're up.
Yeah, definitely. Trade, yes, in the gold, because the futures market, they don't relate to the ETF, but the futures market mostly for day trades only. But invest in it? No, not in my portfolio. Not that it's been down as much as it has, at least in the downtrend, intermediate and short-term trends there. But the idea that gold, you mentioned John Murphy's book, is a wonderful, wonderful book as well for intermarket. Same thing. It's the argument with the central banks printing money, all these sort of aspects. Gold's going to shoot sky high. That's not worked at all. And in fact, again, the price has been downtrending consistently. So we're under 1,200 now. Long term, I don't see that logic shifting. Follow the price, follow the trend. If it starts to be bullish, sure. But in this sense of gold as a hedge against inflation, or against sort of the end of the world, that's not really working out for the market participants. So that's, I would say, for that trading short term, yes. Intraday for me, futures market only, and investing, not at this point.
Gotcha. Okay, Eddie Z, same question. Do you think, do you trade or invest in gold in some form? Do you think gold is an important long-term investment for your portfolio?
I actually do own some gold coins, which is, although I really don't think it's a great investment, and I'll tell you what would make it a great investment and why I don't think at the moment it's a great investment. The only reason I can think to own gold, in my opinion, really is about World War III apocalypse scenario. No, government. Nobody believes in any form of currency anymore. That is the only scenario I can think that gold would have an unbelievable run and be very desirable.
Except for bitcoins, of course. Go ahead. I'm sorry.
Well, if the electricity's
iPhone's
out, I don't know if we're going to be logging into our Bitcoin accounts. But I mean, gold is created and it's never destroyed. So if you think about the supply and demand characteristics of gold, it's never destroyed. There's very few industrial usages or uses of gold, and so that's why I like stocks. You have a fixed pool of shares in a given float, and it's the demand that varies. In gold, you have this ever-increasing supply of gold, and that's it.
Yeah, and one of the interesting things that some people have brought up before, especially when gold starts going up and starts hitting new highs, is that silver is actually being used up. And technically, according to that argument, at some point in time, silver could actually surpass gold, but that might be a long time from now. All right, Neil, let's go over to you. Do you trade or invest in gold in some form? Do you think gold is an important long-term investment in your portfolio?
Yeah, we do trade, actually. We got out of a call option in gold on Friday using GLD, and funny thing was we had a conditional order set for it that triggered right in the middle of the Fed announcement.
Wow.
So I anticipated that the dollar would go down if the Fed talk was there, and then gold would go up, and it triggered, and boom. So I got an email from a guy today, made 45% on those calls in just a couple of days. So that was awesome, and we're in DGP as well for stocks, the leveraged gold ETF, and mainly because it's a U.S. dollar trade, right? I think what happened was the U.S. dollar was strong for so long that gold got oversold. Compared to, like, if the US dollar went up in a linear line and gold went down in a linear line, it went down more than it should have in congruence with that. So now, even if the dollar was to go sideways, gold's going to go up because it has to make up for being too oversold. So I think gold is a good play right now. Maybe it's going to go up $100, but it's still a trade, and that's what the market is showing. But for long term, not necessarily. 10 years ago, it's a true story. I met a guy who was one of these guys, lives, way out in the wilderness and comes into town once in a while. Knew a friend of mine.
Sounds
somehow
like
we
you.
met him at the grocery store or something. Huh?
I said it
Yeah,
sounds like
so,
you.
Anyway, 10 years ago, he said the world's going to come to an end, everything's going to go back to the Stone Age, and he looked so proud of himself, and he goes, "You know what I did?" We're like, "What?" He said, "I buried 20 grand in the backyard, man. No one's ever going to find it." And this is U.S. dollars, but he thinks the world's coming to an end. I'm looking at this guy, I'm like, dude.
The worm
And
will
then
find it.
if it was true, and he turned that into gold coins and then buried the gold coins, he would have been up 500% in 10 years. And he just had his dollars. Yeah. So
My
I always
goodness.
wonder what happened to that guy. Yeah, but I mean, if you're going to hold something for 100 years and store it in a cave somewhere, yeah, go for the coins, but go for the gold. But it's just a trade, just like anything else is a trade,
Amen.
And I think with the markets and everything today, things move so fast. So, I mean, if you're up 500% in gold, why would you keep holding it?
Yeah.
I mean, the dollar's not going to go down 80% during that time. So everything's a trade. So right now it's a trade, and I think silver coins are maybe a good deal now, but if you can sell them at 50, 60, 70 bucks in 5 years, I would also do that. So
Yeah, I'm going to agree with you on the trade, and I'll come back to that in 1 second and throw out a couple of possible things to watch for. As far as physical gold, I do own some physical silver, and when I was a very young kid, when interviewed on trading, I often tell this story. In the schoolyards, I would pay, I think 50 cents or whatever it was for every quarter, and I'd pay a little premium on any kid who could bring me a 1964 or older coin. And eventually that buying came to a screeching halt, and I think that either the kids got wise to me or, unfortunately, I think their parents got wise to me. And I don't know for a fact, but I'm a little concerned that I might have bought off a few coin collections when I was younger. But I remember at one point when I was a little bit older, during the Hunt Brothers bubble, as a young kid, I had a substantial amount of money based on that trading. Unfortunately, that was my first lesson in bubbles. I see no reason to sell my silver. And people, I'm not a conspiracy theorist or anything, and in some of these cases, somebody just mentioned the zombie apocalypse of World War III, and maybe I don't want to even be alive for that. It's like, what's the purpose? But some people have argued, as I said earlier, that silver is being used up, and then who was just saying? I think Eddie was saying that all the gold's ever been created, and it's just still around, and more is being created. Silver is getting used up, so at some point, I think silver would be a long-term play. But again, I'm not an investor. I don't believe in investing in anything. I get emails all the time. Well, there's got to be something you invest in. I'm like, no, I don't believe. I believe in trading. But the other argument about silver too is, let's say you got an ounce of gold and the whole world comes unglued and it's worth, let's say, $5,000. You're not going to be able to go down and buy some groceries with that. But if you got some
Exactly.
silver, Yeah, if you got some silver dimes, they'll be
Yeah.
worth, let's say, $50 a piece. Maybe you can go buy some groceries with that.
Yeah.
But again, I'm not a conspiracy theorist, but I think if you just happen to collect it as a hobby or whatever, I think it's okay to have some coins. Like Eddie Z said, he's got some coins. I think there's nothing wrong with that. It's a hobby to where, I spend a lot of money and waste a lot of money on my hobbies. I think it's one hobby where you probably can at least break even if you're willing to hold on to them. Now, as far as the trade, I'm a big fan of what I call the bow tie, as I mentioned earlier, or other emerging trend type of patterns. I don't believe in bottom picking, but I think that in an efficient market like gold, when they begin to bottom out, you could look for some of these patterns, and we might be coming up on a buy signal soon. And again, the pattern would be the bow tie. You could email me if you need it, or you could get that off of YouTube. But a lot of times in these efficient market like gold, you could get some nice moves off of the lows. We've gone after the gold stocks, I think about 3 times over the last couple of years, and 2 out of 3 times we failed miserably. And I think that we're probably at a either break even or a slight loss on that. But if they set up again, I'll take them again as a trader, just like Neil really pointed out and drove that point home. Again, I think Neil also said that we could end up with a double whammy if gold begins to take off and if the dollar begins to implode. As you probably know, gold is a dollar-denominated instrument, so that could certainly, if the dollar begins to crash, which the dollar's in a bubble, eventually it will crash. Gold could really take off. So I think it pays to be a trader and take your signals when you get them. Just know that you might lose on those signals. I think the gold stocks would be a better play than the underlying commodity, but I'm willing to trade both. We just took trades recently in oil, the underlying commodity via USO, and the all stocks, and neither one of them worked alongside. But we had a bunch of biotechs in the portfolio that I took off, and that's what being a trend guy is all about. You're going to be wrong sometimes, and then sometimes you're going to be right big, as we have recently in those biotechs. I'm not saying it to brag. I'm just saying I want people to know that we don't just lose money. We make some, too. Corey, let's go to you. Any closing thoughts about the market or anything else you want to tell anyone that might be listening today? And then tell us a little bit more about AfraidToTrade.com.
Sure. What I do is, in terms of my trading strategies, real quick, I look at the broader narrative. Whatever market I'm trading, I typically focus on the S&P futures, but also do intermarket as well. But that's just a broader narrative. What's driving the market, what news events, what chart events, all that. Create your thesis. Level 2 or plan 2 is your game planning or level planning. And then the third level, what we do is just actually executing. So for gold, short-term trading of it right now, in this 1,200 level, a little bit of a negative divergence. Yeah, I think for a longer-term position, well, swing trade at least, it would be bullish off of 1140. If it breaks 1100, my goodness, that was going to continue this downtrend. But I'm focusing right now on 1200 in gold, oil. That downtrend continues as well, and the dollar pullback level to about 97.50. Watching those, so these are contra-trend moves. I think Neil mentioned that it's contra-trend moves. If these trends continue, we'll play in those directions. S&P, same thing. So a lot of it's momentum, a lot of it's trend following. As much as I've studied and done research, it really does come back to the trend, and that's your simplest, most efficient way to trade. I think, from my experience, is just going with that trend. With Afraid to Trade, we do that. So we do stock scanning, sector rotation, a little bit of intramarket, create this bigger picture, and then drill down from a top-down approach to planning. And if things go wrong in terms of expectations or dominant thesis, that's not frustrating. That also gives opportunities. We always say if something should happen but doesn't happen, that usually leads to a bigger than expected move in that opposite direction. So for those that think the market should go up, all of us really, if the market stalls this level, it can go down much harder. But that's kind of what drives my trading. Follow the trend, follow your dominant thesis, create a game plan, neutral, objective game plan, play it in real time, and be ready for those alternate moves, because some big profits lie when something shouldn't happen in these markets.
Yeah, I fully agree with that, and that's why I like these emerging trend patterns. I don't try to be a top picker or a bottom picker, but when an emerging trend pattern, even in an efficient market like S&P futures or gold, begins to emerge, you have the most amount of people on the wrong side of the market, and you get that big move really quickly. Just one thing I want to touch upon, you said you emphasized trading with the trend. Obviously, I'm a huge fan of trend trading, and many, many years ago, one of the things I learned was when I would do mechanical testing, and I'm not a mechanical guy anymore. I don't want to get into all that at this moment, but just I spent a lot of time. I have a degree in computer science, so I spent a lot of time mechanically testing systems. And that's what actually made me a discretionary trader. But I also did some consulting in that, and if somebody would present me with a system, I would say, look, it doesn't work on the short side, but if we throw a moving average in there and we just trade when it's below the moving average, it actually would begin working. So it's amazing how important a trend is. Just some little simple thing like a moving average can help, not necessarily guarantee, but help you stay on the right side of the market.
Yeah, absolutely.
Okay, I didn't mean to go off on that, but I just fully agree with what you said. Again, no controversy this week. Sorry, David Kosminder. All right, Eddie Z, let's go to you. Any closing thoughts? Anything else you want to tell us about EasyTradingComputers.net and EasyBreakouts.com?
Yeah, my only...
Someone's Yahoo Finance is going over everything. Does anyone hear this? Or is it just me?
I don't hear it.
Do the voices in my head bother you? All right, Eddie.
All right, no problem. Hopefully everybody can hear me. Look, the bottom line is that with the U.S. stock market is that the institutions are in control. They control at least 85% of the action in the stock market. And the only way to know what they're really up to is by monitoring the volume. Volume is everything. Volume always signals a move. So when it comes to the overall market, you have to look for a number of what I call distribution days stack up in a row. In other words, you get days where the major indexes, the S&P and the NASDAQ, to me are the most important, where they're down on heavier volume than the previous day. And that's the definition of a distribution day. You get 4, 5, 6, or 7 of those stacked up in a 2 or 3 week period, and that's the top of the market. And until that happens, there's really no reason to be out because you want to ride on the coattails of the institutions. That's what I teach inside of Easy Breakouts. So we look for stocks that are breaking out on heavy volume. In other words, stocks that are hitting new high ground on extraordinary volume. Like I said before, stocks have a limited float. There's a limited supply of any given company on every single day. There's only X number of shares out there. And if the demand for a stock increases, it's going to go higher. That means the institutions are in there accumulating shares. So I mean, that's what we teach inside of Easy Breakouts. And so if you put those two together, you know, what's the market going to do next? You know, so that's the kind of stuff we teach. I think volume is everything, the most important piece of the puzzle.
Okay, well maybe we can have a little controversy this week. I'm not a big fan at all of using volume. In fact, I completely ignore it. But my point is always that it's not my way or highway. If you find a way to make it work for you, then use it. It sounds like you've got some well thought things. I guess the only question I'd have to ask you is, how has high frequency trading and derivatives affected your volume analysis, or are you just focusing mostly on the volume and indices and you're not finding a big impact by those?
I don't think it's had any impact whatsoever.
Okay.
You can take a look at the cup and handle chart pattern, the flat base, the high handle, or what some people call a bull flag, and a double bottom formation. Those are the 4 chart patterns I follow. You can find examples of those going back 150 years. You can find examples of those today. The patterns have not changed. If you look at the overall market volumes over the last 5 years, they're diminishing. They're not going up. High-frequency trading is playing a smaller and smaller role than it was even 5 years ago. So the high-frequency argument, I mean, I read the book, I read Flash Boys, and you know, to me, it's just the same old story that's been around forever, which is front-running. These guys, everybody has always tried to find a way to front-run. I started on the floor of the New York Mercantile Exchange in 1987, and I was a clerk, 17 years old, and there were guys in there standing in the pit trading their own accounts, and they were standing next to the guys who were handling the big paper orders as they came in, and they were just feeding off those institutional orders and front-running like you wouldn't believe. When I became a stockbroker, stuff still traded in fractions. Frequently, you would see stocks with $1 spread or even $1.50 spread. And by the time I wrote the ticket out, manually, ran it over to the order desk where it was input into a computer and wired to a, quote, market maker who worked at my firm, who was also trying to front run. And you got your execution back 2 minutes later. 4 people had already front run you. So, flash trading, these flash traders, these high frequency traders, yes, they're in there front running. It's happening. There's no doubt. Does it create some unusual moves? Yes, it does. But it's actually less than it's ever been. Front running, people are always going to try to figure out a way to front run. It's since the beginning of markets, there's been front runnings. But the patterns are exactly the same. And even with all the front running, institutions are loaded with money. Their job is to create an investment portfolio of growth companies. And so they're constantly scouring the market. You know, obviously they're not that great at it. As we know, most mutual funds cannot match the returns of just the indexes themselves, but they're out there accumulating these stocks. So that's why I think it's so important to watch the volume and what they're doing. And I don't think high frequency trading, I mean, these guys go home flat every day. I don't think it really affects anything at all.
Okay, so you're instead of using a high-speed line, you had high-speed sneakers back then. I guess some Nike sneakers.
Goodness. It was, I mean, it wasn't even that long ago. I know, people think, to me, sometimes it seems like yesterday.
Yeah. Quick question. Were you on the floor before October or after October of '87?
I started on the floor in the summer of '87, but I was on the New York Merc, and they were trading crude oil, heating oil, natural gas. So I was not, and that was that summer. And I started at Penn State in that fall.
Oh, okay. Okay. Cool. All right, Neil Batho of TraderReview.com. Any closing thoughts? Anything you want to tell us about Asia, about your trading, or about your website, TraderReview.com? To you, Neil.
Yeah. First, thanks a lot for those cool stories about being on the floor.
Yeah. Fun on that.
Oh, no problem. I got plenty of them.
Okay, yeah. Can write more about them. I like that kind of stuff. I got an email from a guy today because I send out, a lot of free commentary on my website. People can sign up for, but this is what a guy said. He said, "Thanks for the video. I'm still very weary of how it's always easy to just sit back, look at a chart, and say a good entry trade would be here and there when looking at past patterns. Realistically, when you're looking at any live candle, real-time feed, wondering which way the chart will move, it's always going to be a 50-50 guess, isn't it?" So he seems to think that charts don't matter at all, and it's just a 50-50 guess either way. And if you're looking at maybe a 1 second chart, maybe that's kind of true. But what I wrote back, and I said, when you're trading like a smaller time frame, it's always best to go in the same direction as the larger time frame. So you're trading Forex. You trade the 5-minute in the same direction as the 60, in the same direction as the 120, the 240, the daily, maybe not the weekly, but at least up to the daily. And so many people, when they trade, they're always seeming to try to do the opposite. Like, oil's going down, down, down. When am I going to buy it? When am I going to buy it? When am I going to buy it? But you really got to look for some kind of trending, some kind of breakout, some kind of breakdown, not trying to time something exactly to the second by doing the opposite. So that's kind of what I wanted to get in on some charting, just because I got this email today and I thought it was relevant, because the patterns do always repeat themselves. Like Eddie was saying, they go back 100 years. They go back probably thousands of years.
Amen.
They just keep repeating them because people keep making the same mistakes, and people want to follow the herd.
Amen. And I did like the not to get back away. We're going the wrong way in the controversy, but the patterns that Eddie mentioned, I am a big fan of those particular patterns. So anyway, I didn't mean to cut you off. Just kind of agree with you on that. Any other things or any closing thoughts you want to let us know here? I'm sorry, did I say Eddie? I meant Neil.
Yeah, no problem. No, just closing thoughts. as long as the dollar's going down or even sideways, gold is a buy. If the dollar starts to rally up, start breaking out a little bit, gold is not going to be a buy. So everything's going to be about the dollar at this point. And I think the dollar, if I use the Ichimoku cloud, and if you bring up the cloud, you bring up the dollar, I'd look for a bounce at the top of that cloud. I'm not sure where the number is right now. But I'm long-term dollar bull. I think the dollar can rally 20% more over the next couple of years, just compared to the Aussie dollar, Canadian dollar, and a few other currencies. It hasn't even come close to where it has been in the past. So long-term dollar bull, but not right now.
Gotcha.
That's about it.
Good stuff. You brought up percent correct. It got me thinking. And last week I was at a webinar, and then there was a mechanical trader in there, Art Collins. And then as he was closing up his webinar, he was showing that percent correct is really not that important. In fact, as I learned many years ago when I was doing some mechanical testing, when I tried to make systems more correct, they actually lost more and more money. So people think, oh well, if you're only 50% correct, that's not good. But longer-term trend following, you're probably only going to be correct about 30% of the time, which is pretty scary, and that's why I do take a hybrid approach. So hopefully I'm a little bit more correct shorter term and get that timing just right, and I get that pullback pattern, and you get that reversion to the mean move, and a lot more correct than 50-50. But I don't worry about it too much. We got stopped out of 3 trades, and we got 4 trades left, and the 4 trades that are still on are doing exceptionally well, and if those trades run up a couple of 100%, then I'm happy, and I don't care whether or not I was only 40% correct in those. So don't get too caught up in percent correct. The other thing I'd like to just mention real quick, since you kind of might be thinking about statistics, is that well, statistics are worthless. Easy for me to say. 75% of all people know that. But
Homer Simpson, right?
Yeah, Homer Simpson. But when it comes to the markets, they truly are worthless because the market is not normally distributed, and people have to remember that. And the argument that I often give is if it was normally distributed, then whoever, my buddy over there, Eddie Z, with his big, powerful computers, would own the markets because he'd have the best computers out there. But unfortunately, that's not the case, or whoever knew the most about statistics would own the markets. You take a look at like the casino industry; their edge is very small overall, and it's a multi-trillion-dollar industry. They've got that tiny little edge. So if you knew you always would have an edge, then you could just print money forever and you'd own the world. And the fact is, that's not true. So we all take educated guesses at what we do. We know we can be wrong, and that's why money management is also crucial. And I probably spend too much time talking about money management and not as much time talking about how exciting trading could be, because I want to temper everybody's expectations. But anyway, I think I've said enough. DaveLandry.com if you want some more information. They've got plenty of information under education there. And if you actually click on store, like I said earlier, I have a free report that pretty much sums up the methodology. If you understand that, you understand the crux of what I do, and the rest is just details. Thank you once again, David Kosmider and TimingResearch.com for having me. And David, I'm going to turn the show back over to you. Thank you, man.
All right. Thanks, guys. I just want to remind everyone who's watching to go to TimingResearch.com/reports. You can download the report we talked about today or any past reports there. Also, be sure to go to TimingResearch.com/current survey sometime before next Sunday to fill out the survey for this week. Just want to also thank my guests, Neil Batho of TraderReview.com, Corey Rosenbloom of AfraidToTrade.com, Eddie Z of EasyTradingComputers.net and EasyBreakouts.com, and of course Dave Landry. Thanks for hosting again, DaveLandry.com.
Thank you.
That's it. Thanks, guys.
Thank you, David.
Thank you.
Thank you guys for attending.